Audio Jungle.
If you would get a chance to ask one question to the best investor you could find, let's say Warren Buffett, just one thing, what would it be? Let me know in the comments. I'd love to read your creative comments and pin it if I find it thoughtful. So back to the question, what would you ask? Revealing the sources from where he learned to be a master at picking stocks? From where did he learn to make his billions and billions worth of wealth? But guess what? Warren Buffett has already revealed the secret behind his success. And I'm sure you'd have already guessed it from the title. It's The Global Sensation by Mr. Ben Graham, the intelligent investor. To make things easier for you guys, I personally gave this book a read and noted some important lessons that I think would not only shape you into becoming a smarter investor, but also a rich one. So coming back to Mr. Buffett revealing the secret behind his knowledge, he once revealed in an interview, I was 19, yani Mr. Buffett himself, when I picked up The Intelligent Investor, and since then, my investing psychology totally changed. He also said, I would have been a different person with a different life if I hadn't read this book early in my life. Now, according to himself, Warren is a huge reader, as if he gets paid to do it. In an interview, he mentioned how he reads for about 5 to 6 hours every day, non-stop. Newspapers, magazines, books, everything. Now imagine how many uncountable books he must have read. 150, 200, 400. Uncountable. And out of those uncountable books, he recommends and entitles this single book as by far the best book on investing out there. कुछ तो खास होगा ना इस बुक के बारे में जो सारी दुनिया तारीफ कर रही है? The fact that this book has gained so much popularity and still proves to be a valuable source of learning even after being 80-90 years old is absolutely amazing. And the credit goes to Benjamin Graham, the author, for making this book so easy and a piece of cake to understand that even a 12-13-year-old could understand the concepts written in this book. Now, what are these concepts everyone is talking about? Why is everyone going mad after a book that was published when people barely had television in their homes? Isn't it really crazy to hear? Isn't it mind-blowing? Acha, one more amazing thing about this review is that we'll not only dive deep into what Benjamin has written, but also pick stocks and discuss strategies how we could be amazing investors, just like the ones we take inspiration from. Now, to begin with, Graham's book can be broken down into 3 to 4 takeaways. Each takeaway is filled with detailed analysis and interpretations to support the conclusion. From start to end, Mr. Ben breaks and teaches from the beginning. Like number 1, how to draw a line between a true investor and someone who has jumped in the market thinking they could make money with a snap of the fingers. Number 2, after that, he also throws some light on how to actually be an investor, which includes knowing how to pick the right stocks or stocks that are cheap. Number 3, he also helps to set the right margin of safety, that is minimizing the odds of you losing money. And number 4, learn to know how to keep yourself calm, that is how to ride the tides of the stock market. Ye sab in short I've listed them here. Iske alawa, we'll also take a look at formulas for determining whether a stock is overpriced or not and formulas to assess performance metrics of the company, etc., etc. That's right, Mr. Ben Graham has already told us amazing formulas, जो कि truly accurate हैं. How can I be so confident? That's because मैंने खुद इन पर research करके कुछ Indian stocks पर apply किया है. I'll show you these stocks in the end, so make sure you watch till the end. One more amazing fact about this book that I believe is the true reason behind its success is that book is learnable for anyone living in any corner of the world interested to invest in any stock market that exists. It's not like Benjamin Graham ने सिर्फ US audience के लिए ये book लिखी है. Instead, investors from all over the globe are now a fan of his writings, including Warren Buffett जैसे outstanding giants. And that is only because Mr. Ben Graham has done a wonderful job writing this book. Just like I've done making this video for every Indian out there. Don't waste this opportunity since there'll be things that you do not want to miss at any cost. So let's hop on to the very first takeaway, which is comparing two initial concepts of people who exist in the market. Number 1, the investor, and number 2, the speculator. Now, if we try to understand the concept of investing from Ben Graham's point of view, though it is quite different from what we think nowadays. आजकल तो हर कोई पैसा लगाने वाला खुद को इन्वेस्टर कहता है, लेकिन अकॉर्डिंग टू बेन ऐसा बिल्कुल नहीं होना चाहिए. A person should be called an investor only and only if he takes a rational approach or mindset while making his or her investments. अब rational approach बोले तो number 1, thoroughly analyze the performance metrics of the stock. Number 2, analyzing the company's profitability. Number 3, their cash flow. Number 4, their assets. And number 5, their dominance in the market, etc., etc. Targeting for adequate profits is also a part of being an intelligent investor. Sometimes slow and steady wins the race. So thorough analysis plus less risky stocks, yani big market cap companies, are the key ingredients to be called a real investor. Now pause here for a second. Curiosity build hui? Jana चाहते हो कैसे analyze करना है stock को? Go watch my video on how beginners can invest into the Indian market. You'll find the link in the top right corner. Go check that video out so you could have the basic knowledge first and then you can step up your game by coming back to this video. तो ये तो हो गई एक rational investor mindset. Now दूसरा mindset is what Ben called as the speculator. Now an amazing fact is that most of us unknowingly, including me sometimes, fall into this category of being a speculator. A person who forms a theory or conjecture without a subject, without firm evidence. The literal definition straight up translates to what it means. Here's an example with a real public company listed in NSE. Let's say you heard a news. Milestone Furniture, जो कि plastic और furniture products बनाते हैं, now अचानक से उनका new product launch होता है market में, जिसकी वो खूब promotion करके channels और billboards पर लगा देते हैं. देखिए नाजरीन, हमने लॉन्च किया है मार्केट में एक गजब का सोफा जो कि इंडिया का नंबर 1 है. अभी बाय करें एंड चेंज योर लाइफ फॉरएवर, एटसेट्रा एटसेट्रा. Now for a second, let's suppose that their product is actually a game changer. You'll think इनका प्रोडक्ट अच्छा है, मार्केट में तबाही कर देगा, इस कंपनी को बहुत प्रॉफिट बना कर देगा. Let's buy Milestone Furniture stock. You buy the stock, turns out the stock actually gets pumped and you start to make some profits. After a few months, you're like, मजा आ गया, अब तो मैं एक लैंड क्रूजर या रेंज रोवर लूंगा. Just then, the quarterly report gets public, and it turns out the company was already going in a loss of 20 to 30 million rupees. How? The weight of the unsuccessful product launches in the past could not let Milestone swim freely. And even if this single successful product could move some weight out of the company's shoulders, it still can't make Milestone Furniture go into profit and let them swim freely around. Hence, you would likely see your investment going into the water for the sake of not researching and going into depth properly. This is what a speculator does. And now you know if you want to be on the investor side or on the sinking ship of a speculator. Takeaway number 2, finding true gems or profitable stocks. At this point, I would suggest you keep a diary or make notes on your phone since things will start to get technical and to the point. So initially, let's talk about the 2 categories of investors. The basic differences related to the stock picking criteria, which is the key takeaway of this point, and the time they can dedicate to stay incorporated into the stocks they picked. Both categories have their own pros and cons. I'll compare both of them and let you decide the best. Later, you get to decide which category suits you. Number 1 is the defensive investor, which is the majority. You don't have time and can't add effort to investing. You've ideally got a job, work, business, etc. You can hardly manage time for investing on the weekends, plus the only reason you're investing is that you have some extra cash to spare and you probably don't want to blow it off, but rather investing it in stocks and seeing it multiply over the years. Then you are a defensive investor, which is basically the case of 80% of investors. Ben Graham also talks about the criteria you must look at before you park your money somewhere in the stock market. These are absolutely easy to understand and speculate, which means even you can do it at your home, over any stock market out there, and at any time of the year. So without further ado, pick up something to note down and let's get started. Diversify. On page 129 of his book, he says, don't invest in only one stock. Ideally, between 10 to 30 stocks are a good starting point for investors, but you must make sure you're not overexposed to one industry. Only go for larger cap public companies. Now, Mr. Ben mentions that companies having earned over $100 million should be considered. But if we consider the fact that this book was written in the 1940s, then by now, that $100 million will be nearly $700 million. So the earnings barrier gets to be at 700 million. Earnings growth per year should be at least 3%, which is pretty low for big markets like India and the USA, but it's okay. Let's work along with it. Number 4, the company should be having a clean record of past earnings, no losses and no unpaid dividends. It should be clear that they also care about their investors as well and should not only be valuable but also cheap. What does that mean? This means you don't pick companies that are overpriced or overhyped, no matter if they are doing really well and satisfy the above mentioned points. Now, how do you determine whether a stock is undervalued or overvalued? Don't you worry, because Mr. Ben has already an answer for that. Use a simple formula that does the magic of separating gold from the dirt. If the market cap, which is the number of stocks a company has issued in the stock market multiplied by individual stock price, is less than 1.5 times net assets, or market cap is less than 1.5 times assets minus liabilities. Only and only if the above relation is met, it is then safe to say that the stock is undervalued. The lower the market cap as compared to net assets, the more profitable the stock will be in the near future. Keep a margin of safe difference just in case the difference isn't very much. Now you may ask how easy it is to find to stop the real deal, right? But no, my friend, we aren't done. Most companies don't directly disclose their net assets and liabilities so easily. You have to go through their balance sheet and do the math yourself. Now, if you want me to also teach you guys how to read balance sheets, let me know in the comments and I'll make a video on that as well. I've done some research on my own. Let's do a quick real-life example of Bajaj Holding. Their market cap is around 54,787 crore. Debt-to-equity ratio 0.31, which is pretty low as well. 5-year historical growth rate almost 46%. Amazing. While the net assets are around 44,118 crore. Now, if we multiply this 44,000 crore with 1.5, we'll get something like 66,000 crore, which is significantly larger than their market cap. Hence, it is safe to say that Bajaj Holdings qualifies as a stock an intelligent investor would choose, at least according to Mr. Ben Graham. Number 2, enterprising investor. This consists of businessmen and fund managers or risk takers. Enterprising investor के पास time ही time है, and most importantly, an interest in stocks with the hunger to get rich. Basically, if you can spend time staying connected to the decisions happening in each of the companies you picked, like listening to their press releases, decisions they're making for the growth of the company, etc., then you're an enterprising investor. The stock picking criteria are the same for enterprising investors. The only difference is that they can be somewhat lenient while cherry-picking stocks, like the earnings don't have to be over $700 million. It can be somewhere around $500 million or something. Profitability for the last 5 to 10 years can be around 4 to 5% at the lowest. Apart from all these points, one thing has to be common, and that is your portfolio should have at least 25 to 35% of bonds acting as safe cushions during the highs and lows of the volatile market. Like ICICI Prudential Bond Funds, Axis Dynamic Bond Funds yields around 7 to 9% after the maturity period, fixed tenure depending on the fund's manager's plan. Average maturity time is around 3 to 4 years. Other than that, on the same page number 129, he writes, if, after you set up an autopilot portfolio, that is the defensive investor's portfolio, and you find yourself trading a few times in a year or spending an hour or two per month total checking on your investments, then there's something bad going wrong. In short, what Mr. Ben means is that you should be sitting back and taking a chill once your money's gone in exchange for stock. If you're getting worried as there's news of the market dropping a few percentages, which happens like every week or even multiple times a day, then there are two possible things that are going bad. Number 1, you either don't have control over your emotions, which means you get pressurized very easily, seeing your money go up and then down. Any global emergency, disaster, recessions, or bad actions taken by the government can cause a bump in the prices. But overall, in the long run, we don't have to worry even for a teeny tiny bit. Or you either didn't pick the right stock in the first place. Not doing right any or both of these can destroy your dreams of making money from the stock market, since both are crucial and necessary to have the mindset and the capability of being a successful investor.